Business valuation. When you determine the value of a business, it's sort of a gray area. There are some guidelines that we're going to go through, but they're still not written in stone. We will start with a couple of premises though. First, that a business isn't worth anything until it's profitable. And people like to see at least 3 years of profitability before they look at purchasing. And second, your business is worth what the market says it is. So if you believe that a business is worth more or less than what is being asked, you have to be able to provide an explanation. There are different ways to value a business, as we discussed. The most concrete is asset valuation, because you're looking at the value of things that you can look, feel, and touch. Those include your physical assets like machinery, office furniture, computers. They can include intellectual property, things that you can't really touch, but that have built over time. So if a company has a registered patent or trademark and corporation, something that adds concrete value, that adds specific value to the business, that protects information. A little less easy to evaluate the actual value are the owners, employees, and vendor relationships and customer relationships. These can be difficult to be evaluated because you can't, especially with employees and customers, you can't guarantee they're going to stay put. Being able to purchase the business and keep an owner on for a while can be a little easier because that's written into the paperwork. So not only are you looking at the value of the business itself, but you're also looking at the earning potential. So that incorporates not just the business, but the market as a whole. So you need to be able to estimate the size and growth of the market based on trends that are occurring and that you anticipate occurring. You also are going to look at the competition and any barriers that occur that could damage or reduce the market share that you could have. A business may consider itself more valuable because it has unique traits, but that could be misleading because it really depends on if the customers consider those unique traits enough of a draw to make it worthwhile. So the first way that we're going to look at valuing a business is through income flow. Again, it assumes that the business has been making a profit for at least 3 years. What we're going to be doing is a very simplified format, but it gives you a fair ballpark for what you'd be willing to pay for a business. So looking at their financials, and as an FYI, if a company isn't willing to show you full financials, run away. But you'd start with the annual earnings before taxes, and then you'd add owner income. So that tells you what has been earned by the business overall. You'd subtract any unpaid expenses, including depreciation, because that would be paid off during the sale. You'd also subtract one-time only income because that would go to the existing owner. So once you've subtracted those items from the value, the total value or the total income that you've determined, then you multiply by 3 to 5 depending upon the market how the market trend is going. So in this case, the business would be worth somewhere between $90,000 and $150,000. Another way that you can determine value is from free cash flow method. So you're looking at the financials, and it's all based in this case on net after-tax earnings, including owner's salary. You would ignore any interest on the existing loans because everything there would be paid off in a sale because you wouldn't pick up any loans that were in existence. So if you are going to be borrowing money to buy this business, you'd be looking at, in this case, let's use 4 because that's what we have on the slide. So 4 years times 80,000 is our earning goal, so 320,000, and then you take out that down payment from that, so that gives you 240,000. So that leaves you the amount that is available to make interest and principal payments over the lifetime of the loan and to provide the new owner with return on investment. So in this case, that 320 minus the 80 down payment, we got that 240. 240,000 divided by the 4 years that the loan is going to run is $60,000. So on that 80,000, the new owner expects a 20% return per year, so $16,000. So that reduces the amount available to pay debt payments to $44,000. You'd multiply the loan number in years to get the total amount available including interest. So your annual loan payments of $44,000 support a 4-year loan at 8% of $150,000 to $175,000 including interest, and 10% interest, $144,000 to $175,000. That's with interest. So when you add the principal loan, so the money that you're putting down, you arrive at a total purchase price of $230,000 to $224,000. So then you have to look at the value of the business overall and see if the lender is willing to finance the deal for that frame and that price.